Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance. Here are your hosts, Lucas Muzialski and Leo Severino.
Hello everyone, and welcome to the fourth episode of the Wall Street Lab podcast. Today, me and Leo were sitting together in Frankfurt again, and we have just finished an interview with another great guest, Brian Tomlinson. Leo, why don't you give us some background on what Brian has been up to?
Sure. So Brian is currently a global fixed income portfolio manager at Allianz Global Investors, where he has been for almost 4 years. He also spent 7 years at Pimco and other companies that most of you will be familiar with, such as Merrill Lynch, Citi Bank, Dresdner Bank, and IBM. So in the conversation, we talked about how he positioned his portfolio before the Brexit vote and how he was able to profit from the Trump election as well. We also touch on some advice that he gives to young professionals, how he got into fixed income. It's a great story about his grandfather and many other things. We actually really learned a whole lot from this conversation, and we hope that you will as well.
And before we jump into the conversation with Brian, we would just like to ask you guys, if you enjoy what you're hearing, please rate us on iTunes. It really helps us grow the show. And without further ado, here is our conversation with Brian Tomlinson.
Brian, welcome to the Wall Street Lab, and thank you for accepting to meet with us today. I guess as a start, it would be interesting if you could tell us how you explain to someone outside of finance what you do.
It's an interesting question because it's one of the things I actually mentioned to new employees and graduates, saying, what is your 20-second elevator speech? If you're getting caught in the elevator with the CEO or the CIO of the company, describe what you do and how you're adding value in less than 20 seconds. So I would explain to an old lady on the street what I do is I make people's dreams come true. I provide them with peace of mind for their retirement so that they have the capital to do what they want to do in their retirement. I take risk so that they don't have to, so that they can focus on doing what they want to in their lives now and know that when they retire, they can live their dreams.
Okay. Yeah, that makes sense. But now, how did you actually get started into taking risks for other people?
Well, I'm going to try to make this short. I have my grandfather to thank for this.
Okay.
And it was 1981. So I'm 50 years old, just for the record. And interest rates then had been deregulated. And they had been always capped at 5%. So you can go to the bank, the maximum you could earn was 5%. Inflation was high in America at that time. And banks had their interest rates around 11%. So you get 11% on a certificate of deposit for 1 year. My grandfather and I were at the bank. I said, Grandpa, I was 12 years old at that time. That's great, 11%. And my grandfather was 80 years old at the time. And he said, no, I'm buying stock. I said, what stock? He goes, I'll show you when we get home. So we got home. He showed me these stock certificates of different companies he had just bought. He cashed in his life insurance policy for $100,000, and he put it all into stock. And I said, what is stock? He goes, well, when a company grows and earns more money, then the price of the stock goes up and you get a dividend. I said, what's a dividend? It's like interest. And I go, well, how much dividend are you getting? He goes, about 3%. I said, I'll take the 11% at the bank. Forget this 3% dividend. So he died 4 years later. And that $100,000 turned into $180,000. So I said to myself, because I grew up on a farm, and I worked 7 days a week. I had no vacation in the summertime. All my friends were taking vacation. I said, I don't want to work with my hands anymore. There are ways to make money without having to use my hands. I need to learn more about financial markets. Because if I have enough capital, I can make more money and live the life that I want. I'll have choice and freedom, quality of life. So if I had to choose 5 minutes to spend with anybody throughout history, dead or alive, it would have been my grandfather, so that I could say, thank you for showing me the way.
Wow. That's a nice way to get an introduction to the financial markets. I guess it's a better way than a lot of other people in this university had the chance to.
So that's actually when I began. Then I was 14 when my grandfather passed away. I decided I went to the library every week when I was 14 and started reading everything I could about currencies, because I loved currencies, because I traveled a lot when I was young. My mother was German. And interest rates and hedge funds. I was excited about hedge funds. So I began at age 14 reading about how financial markets works. I wanted to know how to make money. That was key. And I think one of the biggest disappointments was when I went to university. At university, they don't teach you how to make money.
Right.
Which was the biggest disappointment for me. When I was in my third year at college, I said, I and my parents have spent all this money, and the university hasn't taught me how to make money. So that was my real focus. I wanted to find a way, a style, a system that worked for me to put the pieces of the financial markets together so I can understand it in order to make profit. And if I was to say, if you really want to make money, it's not the money that drives you, it's winning. It's the desire to be right. When I get up every morning, it's not about, how much money can I make today? It's about the world stage, I'm on it. I get the chance to play in it, express my conviction. So I look at the financial markets globally, all asset classes, and I say, what's out of line? What do I disagree with? Where do I see opportunity? And depending on my degree of conviction determines how much I size that trade, how much risk I'll allocate to it. And then I apply a discipline, because if it goes wrong, I don't want that trade to carry me out, so to speak.
It's interesting that you touched on the desire to be right. Mm-hmm. And I've read a few books about traders. There's one book called The Market Wizards, mm-hmm. Hedge Fund Market Wizards. And I think one common theme throughout the book is traders learn to deal with being wrong almost half of the time. So how do you deal with that? Or is that something that you experience at your job?
Pain. I'll give you 2 examples. When I was starting out, when I was younger, I was in my early 20s, mid-20s. I lost money for myself personally and for my parents, which was painful psychologically. Forget the money, it was painful psychologically. The second thing was I ran a large position when I was head of fixed income trading at a large global bank. I lost so much money that it crippled me psychologically, and I wasn't able to recover from that and to take additional risk to make up my losses. So I was short the stock market personally from 1991 to 1993. And I was playing with my parents' retirement money. It wasn't mine. Eventually it would be, because I'll inherit it. So the painful thing is to admit to your parents that you've lost, 20% of their capital, and to see the look on their faces of shock, anger, and disappointment, and not being able to sleep every night and watching the stock market go up and you're short, and it's just costing you money and pain where you can't sleep at night, and it's affecting everything else in your life. When you're losing money, and it's a lot, you also have physical problems. It manifests itself physically. You might shake, sometimes tremble. You'll have pains in your stomach. That's when you know you're wrong, because you got to take your ego out of it. The problem was then my ego was in the way. And I was listening to a market newsletter advisor saying you need to be short, just short. And I thought that market professional knew more than I did. So lesson number 1, don't listen to anybody else when it's about your money. Find a system that works for you. And if you start losing money and you're uncomfortable, cut the position, get out before it cripples you. The second time, I lost a lot of money for a bank because I took a large position in a government bond auction, a 30-year European government bond, and there was no hedge. There was no future to hedge yourself. So, and unfortunately, it was January, the first month of the year. I lost so much money after buying that 30-year bond at the auction because such a huge size relative to my balance sheet and my P&L limit that I broke my P&L limit, i.e. I lost so much money that I had to stop trading.
Okay.
And I was not able to recover for the rest of the year the money I lost because it psychologically crippled me. So don't take so much risks so that if it goes wrong, it cripples you. 2, have a disciplined stop loss so that you can live to trade another day.
A lot of the traders in the book, actually, they talk about not only trading in and outside of positions, but also learning how to trade around positions. And that's probably one of the greatest value added that they can bring to trading. Do you agree with that?
I would say that trading around positions for me means having a core position. And you need to decide if you're going to be, for example, taking a position and it starts moving, you take some profit and then it keeps on running, you raise your stop so that you automatically lock in profit in case it goes wrong. For example, I trade currencies almost every day in my portfolios. Every time I take an active currency position, I put in a stop loss. And if I don't, my trading desk automatically asks me, what is your stop loss? Because they know I always place a stop in the currency markets. Also associated with trading around a position, you have to understand, and this is one of the things I want to stress for everybody who wants to learn about being a trader or being a portfolio manager, is to understand correlations. Different asset markets have certain correlations. And understanding, if you're running, say, a fixed income position, you can actually trade a currency as maybe a hedge against it. It's a more effective way of managing risk sometimes, because currencies trade 24 hours a day, and there's a certain beta or correlation of currencies to fixed income. So sometimes other markets will give you a signal first before it hits your asset class. So that's why I look at all asset classes throughout the day as an early warning indicator of something that could hurt my current position, that would make me change my opinion, that either maybe I need to reduce my position or maybe it gives me added confidence to increase it.
You touched on correlation, and correlation, as far as I understand it, measures the linear relationship between two different asset classes, for example. What happens when the relationship, 1, is not linear, or 2, a 2008 happens and correlations go to near to 1? What happens? What you do as a risk manager in that situation?
Volatility. There's something that is called the carry trade. Everybody is happy and fine buying risk or going long carry and using leverage most of the time until volatility rises. Once volatility rises, and it rises significantly, everything becomes correlated to 1, as you just said. And that's when value at risk models Most everybody uses them, and that's one of the biggest problems. Because when everybody uses the same methodology and systems to measure their risk, as soon as volatility starts rising, who's the first person that gets out of the position? It's the hedge fund, because he's leveraged. Okay? Then the asset managers are usually a few days or a few weeks behind because their value at risk trigger levels are set, calibrated for more tolerance. So then they sell. And then it's the very long-term investors and retail guys who end up selling last. So value at risk models, I'll say this. They are backward-looking, meaning it's depending upon the recent past volatility, which is usually low. So they don't look forward. You, as a trader or portfolio manager, it's your job to determine what volatility is going to do in the future. And how do you do that? I traded options. So options is all about volatility. There's two things I try to do to help me gauge when volatility is going to shift. Number one, I need to know fundamentally upcoming economic events. So I got to have a radar screen. What's coming up in the next days and weeks, or politically, economically, that's going to move markets. Two, I will look at options markets to give me a sense of greed and fear, because when you look at options, you can see basically people's need or desire to hedge risk, buy protection. Look at what are called risk reversals to see if people are buying calls more than puts. And look at the volatility surface and the history of volatility. So Z-scores and volatility. The more simplistic thing that I use for gauging volatility, though, and I don't discuss it with clients because they think it's voodoo, I use technical analysis. I look at charts. Charts don't tell me what people are thinking. Charts tell me what people are doing. And I've been looking at charts for over 28 years, and patterns and cycles repeat. And when I see something that looks familiar, it's for me, gives me an added degree of confidence of where markets are going. So I use charts, technical analysis. I look at options markets, and I look at fundamental events on my radar screen to help me warn me of when volatility is going to shift. And I would say that is my edge versus other portfolio managers who are buy and hold and pray.
That's an interesting point, because you mentioned early that in your third year of college, you realized that college is not going to teach you how to make money. And that's one of the taboos, and especially in finance. Technical analysis is a taboo in business schools. How are you able to differentiate between what you learn in school, or maybe try to forget things that you learn in school once you start working directly with as a trader or portfolio manager?
You got to teach yourself. You either find a mentor in the finance world, or you teach yourself. You read and you do. The best way to learn about trading markets is to trade your own money. And the best thing is if you lose money first. If you make money first, it increases your confidence and you get an ego, and then eventually you're going to take so much risk, you're going to have a massive drawdown. I try to avoid drawdowns because, as I said before, I want to live to trade another day. Theory in school, I'm going to say something very blunt. Going to university is about getting a ticket. They're not going to teach you how to make money at university, because if a professor knew how to make money, he wouldn't be a professor unless he was just retired and doing it for fun. Yeah? So going to university is about getting a ticket that helps you open the door to get a job at a bank or an asset manager. And when you're in there, that's where you learn reality and how markets work.
How did you teach yourself how to deal with your own ego?
It was the desire not to feel that pain and fear. Fear is something in everybody's life, privately. Fear prevents you from learning, from moving forward, to seeing other opportunities. It causes you to freeze. You can't evolve. You can't move forward. I don't like fear. But you have to experience it in order to know when it's approaching. So get rid of the ego. Be fearful every day, so to speak, but so that you protect your position, but not to the point where you're destroyed psychologically. So that's when I decided I really need to create a system for myself that's disciplined. And what I do is I bring together a few different forms of analysis that enables me also to implement discipline so that when I'm wrong, I get out. It's so easy for me now to just hit the sell button and say, I'm out. I don't care anymore. And I'll look for the next trade. My mind is open and free to look for the next opportunity. I've been there sitting at the desk, staring at my screen, watching my position go wrong and cost me money. And it just eats me alive. I can't do anything. I leave work. I'm not happy. I can't communicate. I can't socialize. It's just eating me alive. It consumes me. So it's easier to just say, hit the sell button, wait for the next opportunity, or look at something else. Because life's too short to be gripped by fear and pain.
I guess it's probably a constant struggle to learn how to deal with fear, because fear is probably never going to go away. But in order for you to live your life as a human being, you just have to learn how big where your pain point is. I mean, and you touched on position sizes, never losing more than you can afford, and also learning how to deal with that constant fear that you said you have every day. And I think it's an important part of it.
I think to carry those points a step further, sizing trades, it's all about degrees of conviction. When you see something, you say, this is an opportunity. You have to assign a degree of conviction, i.e. a degree of probability of this happening. So, if I'm 50-50, I don't take the trade. That's the bottom. It's bottom line. If I think there's a 60% possibility, I say, okay, but how do I express a low conviction trade? I'm going to do it probably through the options market, because the maximum I'm going to lose is the premium that I invest in the option. And I also have to decide what's the best instrument for me to express that view. Is it the currency market? Is it the fixed income market? And do I do it in the cash markets, or do I do it in derivative space? So again, about degree of conviction, probability. And it's one thing I taught my son when he was 6 years old. I taught him to play Texas Hold'em poker, okay? Because it's about probabilities.
Yes.
Yeah.
I play Texas Hold'em, but I still can't remember the probabilities of all the hands. But I can see the connection between investing in Texas Hold'em.
And there's a lot of psychology involved as well.
Yeah, exactly.
Absolutely.
That's a good idea. I just 3 months ago I had a daughter, so I think I'll probably teach her at age 6 how to play Texas Hold'em as well. Maybe we'll help her in the future. This is really fascinating to me, because I remember I was sitting in the audience in a presentation that you gave here at Frankfurt School back in May, and that was before the Brexit vote. And I remember you saying, everyone is saying that there's not going to be a Brexit vote, and the markets are not reacting to it. And you told a story that really stuck to me, and I would like you to explain it. I mean, it was similar to what Peter Lynch says in One Up on Wall Street, that the best trades he's ever made in his life were ideas from his wife. His wife would go to a store and say, "Wow, that's a really nice store, and they sell good products, good customer service." And then after that, he would go and look at the financials. So can you please tell your version of that about Brexit?
Sure. So Brexit actually happened around June 21st. So already in March, so 3 months in advance, I was very curious about this because I saw something happening in America already where people were very disenfranchised with politicians. I knew Americans were angry in general. And we've already seen Arab Spring and uprisings. And I just felt this was beginning of some kind of bigger trend globally. So I did some grassroots research on my own. So I went to London every 2 weeks on business. And so I went to the bars, restaurants by myself, and I went up and spoke to the average Joe. Not people who sit in my white ivory towers in the finance world, not in London City or in Frankfurt or Paris, but to the average man in the street. I spoke to older people who were from the countryside, what they thought about Brexit, European Union. I spoke to the cab drivers. So I got outside of the city of London, whose jobs are dependent a lot upon Brexit not happening. And also their views are different than the people who live out in the countryside. Because everybody at my firm said, oh, Brexit's not happening. And I said, why? Why isn't it going to happen? It's just because. I said, something's wrong here. Something stinks. Because what the cab drivers were telling me and what the average person out in the countryside was telling me is that they want out of the European Union. Pretty much for 3 reasons, but those 3 reasons I won't mention on this interview. So I said, there's something wrong here in terms of probability. Everybody in my business is convinced it's not happening. Even in the bookies markets in London, where you can actually bet legally that Brexit would happen or not happen, the odds were only 20% that Brexit would happen, i.e. the UK would vote to leave the European Union. And I said, the odds of Brexit happening are much higher than 20%. I think they're 60%. I'm 50% bid, and the upside's unlimited. So there was a mispricing of probability. So I bought what I call the cheap option. I bought derivatives. So basically if I was wrong and Brexit didn't happen, I would lose €1. If I was right, I would make €4. So I said the risk reward is in my favor, 4-1. So personally, I put on the bet in the bookies markets. It was only £100. But in my portfolios, I bought options. I bought call options because if Brexit was going to happen, there's going to be a massive flight to quality. Bond prices would rise, yields would collapse, the dollar would rise, and the British pound would collapse. So I bought options on all these things. I bought call options on U.S. Treasury bonds, call options on bunds. I bought the U.S. dollar. I sold the British pound. I bought the Swiss franc and sold the euro. I put on all these trades that if it was wrong, I wouldn't lose very much. I would still live the trade another day. But if I was right, I was going to make a killing. And again, it was about being right, not because I had an ego. It was because I saw a mispricing in probabilities. And I chose instruments that would profit exponentially if I was right. And if I was wrong, I wouldn't lose very much. The same thing happened with Trump. Because I told my colleagues a year and a half ago that Trump has a very good chance. And they said, no. So it was election. I put on trades again for a Trump victory, just like for Brexit. I went to bed in London. I was in London around 11 o'clock at night, and it was all forecast. Hillary's going to win. Everything was fine. And boom, my telephone rings at 4:30 in the morning London time. Looks like Trump's going to win. So I didn't even take a shower. I just ran into the office. It was raining. I'm running through the rain, the streets of London, getting to the office like 5:30 in the morning in London. I turn on my computer systems and I traded. I was long treasury bonds and options. I sold them at the high. I mean, it was like Christmas for me, going ka-ching, ka-ching, ka-ching. And then, so I took off my profits on those bets, and then I went the other way. So I sold the euro, I bought the dollar, I sold duration, meaning I sold treasury bonds, I sold bonds, and I went the other way. So I went from long duration to short duration, short the dollar to long the dollar, all within 2 hours, and the markets moved so fast. If you weren't there for those 2 hours in the European time zone from 6 in the morning to 8, you would have missed the trade. And thank God I went in the office and hit the take profit button and then reversed my positions. And so I have a very good performance for the year because of two events. Thank God, and this doesn't happen very often in life where you have two risk events that turn out to be completely the opposite of what people are expecting. But I saw the opportunity from a probabilities perspective, again, looking at the options markets, saying, my risk reward here is really good. I know I can make 4, and I'm willing to lose 1. Again, for students at university, I would encourage them to learn about options. Okay, because many things in life are about options. Think about this. When you walk across the street, you look both ways. And I have to when I'm in London because I look the wrong way in London all the time. I almost get hit by a bus because I'm American. They drive on the other side of the road in England. You cross the street and you don't even think about something. You're doing it subconsciously. What is the probability I'm going to get hit by a bus? Everything you do, a purchase decision, it's all about assigning a probability of an outcome. And when I'm in investment committee meetings every week and the portfolio manager speaks, I said, number 1, what's your degree of conviction on that statement? And 2, what's the probability? And what instrument you're going to use to express that view. So conviction, probability, and which instrument you're going to use. And what's your stop loss.
Okay. So let's talk about the current markets right now. With quantitative easing happening for many years now, some people talking about probably the Bank of Japan at some point will start using helicopter money. And what's your view on the current market, and what's the future going to bring for fixed income managers like yourself?
Well, we've reached the end of quantitative easing because there are no more benefits. They can continue to try to do anything, continue to do quantitative easing, but there's very little benefits to the economy or to the average worker, citizen, for central banks to continue quantitative easing. I will go on the record in saying that quantitative easing, i.e. negative interest rates especially, negative interest rates are crimes against humanity. What does that mean? When you push interest rates into negative territory, you are robbing the saver. That is the 90% of the citizens of a country, basically. It benefits the very rich because the very rich own equities and they own real estate. So those asset classes go up. Negative interest rates, you're robbing the majority. You're robbing the masses. You're denying them savings. And their consumption behavior then changes because they say, I'm not earning interest at the bank. I was used to earning 2% interest, 5%, and that was income that I could use to spend money or I counted on for retirement. So it actually causes disinflation. Negative interest rates helps fuel deflation. It has the opposite effect of what central bankers thought it would have. Central bankers have thought that if you push interest rates into negative territory, people will say, I'm going to spend my money because I'm not earning any interest. People said, I'm going to take my money out of the bank and put it under the mattress because I would rather have it there than in the bank earning negative interest. And I'm not going to spend it because I'm afraid of the future because I'm not earning interest income. And my retirement has just been robbed. And I don't know how I'm going to retire. Fear. So the central bankers dealt in a topic called behavior finance. How is an investor or a consumer going to react to negative interest rates? And they took a gamble and they lost. So we've reached now the end of quantitative easing, and actually yields are rising because this European Central Bank will eventually stop quantitative easing, stop buying bonds. And Trump's policies are pro-growth and pro-inflation. And fiscal expansion, fiscal policy is much more effective than monetary policy. We have reached the end of benefits of monetary easing, unconventional methods of monetary policy in Japan and Europe and in England. It's over. And fixed income portfolio managers realize this, and I'm of the opinion we're going to have to deal with rising yields going forward, which is great for the average man, and which is good for pension funds and insurance companies so they can, again, have higher yields to deal with people who are retiring. So I welcome rising yields. I love volatile markets because volatile markets enables me as an active portfolio manager to do what I do best, take risk and seize opportunities.
Okay. We've been in a equities bull market since 2009. So it's been over 8 years now. And history has shown that it usually takes about 8 to 10 years for us to experience some sort of either crisis or a major drop in equity markets. Knowing that, and it's probably fair to assume that in the next 5 years, it's probably going to be some sort of slowdown in the equity markets. How do you play that game?
Well, I think we have to differentiate which country's stock market. Even though I'm a bond and currency portfolio manager, I'm actually very bullish on the U.S. stock market. I don't care about valuations. The bottom line is the following. The global flows of funds, meaning money around the world, is fleeing countries and going to America. That money is going to America, it's getting invested into the U.S. dollar, and some of that money is going into the stock market. Because the United States is now the best game in town. Growth in America will increase from 2%, which has been the case for the past 6 years, to 4% under Trump's new plans. Interest rates, yields are going up in America because growth and inflation are going to increase. Every central bank is trying to create inflation, and the U.S. has done it now. We'll do it. So money is going to America to invest in a dollar in the U.S. stock market because the U.S. economy will grow, because Trump will cut the taxes of corporations and of individuals, and that will extend the U.S. economic cycle. And this is very key. So the U.S. economic cycle, which should have basically be coming to an end now, has just been granted a new lease on life of probably another 2 years. So as a global portfolio manager, it's part of my job, and I encourage students as well to understand economic cycles. Knowing where a country is in its economic cycle, what stage, i.e. growth, boom, topping out, and then bust, recession, determines what asset class you buy. So I believe that the U.S., because of its new lease on life through Trump's policies, the U.S. stock market will continue to rally. European stock markets will underperform, and the U.S. dollar will strengthen an additional 10 to 20% against the euro, the yen, and the British pound, and probably 20 to 40% against emerging market countries. The U.S. doubling its growth rate is a game changer. Trump's policies are, number one, a game changer and a regime shift. And this is also a phased transition. A phased transition only happens every 10 or 20 years. It is when people realize and shift from one asset class to the next. And they're going to be selling bonds and buying equities. and I believe that the trend for equities in the United States is still a positive one. It should help to support European equity markets on the margin. If I want to be long U.S. equities, U.S. dollar, and short the euro and short European equity markets.
Very interesting. Let's switch gears a little bit and talk a little bit about career-related questions that we've put together for you. Do you believe that there are some innate personality traits that you think you should have if you, for example, if you're trying to hire someone to become an analyst at your team, for example? Do you look for specific personality traits in those people?
I'll tell you what I look at in the first 2 minutes. How the person greets me, his handshake, how he's dressed. In German, we say, Kleidung macht der Mann. Yeah, clothes makes the man. I pay attention to body language and eye contact. And because 90% of what a person says is nonverbal. How is that person's body posture? Nervous, uncomfortable? I want to know what the person's not saying. So what I usually do is I'll have another person help me interview somebody, good cop, bad cop. And I'm usually the global ambassador, so I'm the nice guy. And then my colleague asks the tough questions. And I know within 2 minutes if I want to hire somebody or not. Yeah. I most recently spoke to, it was a telephone interview. I was in London. I was speaking to a MBA graduate from Yale University in Connecticut. That's where I'm from, actually, in Connecticut. Okay. I wasn't smart enough to go to Yale, unfortunately. And after talking to him for like 7 minutes, he goes, "What? It's over? The interview? Yeah, I'm done." So what else I want to look at in terms of a candidate? I want to see if a person takes time to think after being asked a question. Degree of confidence. I want to see how arrogant a person is. If a person comes across as arrogant or cocky, he's automatically dead in my book. He's not getting hired. Because being a trader, a portfolio manager, even an analyst, you got to have humility. You will learn humility in this game. And I don't want to hire somebody who thinks he knows everything already and is just at a university. I want to be a teacher and a mentor, and I can't be a mentor to somebody who thinks he knows more than I do.
Okay. So you believe in the importance of having some sort of mentorship throughout your career?
Absolutely. And we do that at my company. I was fortunate to have 2 mentors in my life that really helped accelerate my career and give me guidance. And I give back. And part of being me taking on somebody younger to teach is they have to make me a promise that they will do the same, that they will mentor other people that they deem worthy. Yeah, so giving back.
Okay. So we've noticed, especially among our colleagues that finished the Masters of Finance program, there are not that many people that say, I would love to be a fixed income portfolio manager. That doesn't come out. There are not a lot of people that come out of business school saying fixed income is my thing. Usually people are attracted to finance because they watch CNBC. And all they talk about usually is, Apple went up or down because of this or that. Usually the reasons don't make a whole lot of sense. But my question is, how would you attract? So what would be the case for attracting more younger professionals to fixed income?
I've been joking the past few years when I get up on stage and speak to audiences, and I say, my next life, I'm going to be an equity fund manager, because dealing with a zero interest rate environment is certainly not interesting for most people. I'll be straightforward here. Equities is about stories. Yeah. Each company has a story. And if you like, most people love stories. It's easy to talk about a story. Story sells, It's colorful. You can, you can put something around it. So there's a stock market, which we just talked about. That's a collection of stocks and companies. But getting down to individual names is really what excites people. As you just said, I want to buy Apple, or I'm looking to find the next Apple, where a stock will go up 500% or something. The people who are actually in the equity business respect bond managers much more than they respect themselves, because they say you really got to be smart to be a bond manager, because of bond math, and we equity guys, we don't understand bonds, but it's important for the economy. If my interest is global macro top down, so I'm interested in economics of countries, regions, what moves currencies, monetary policy. If that's what interests you, then that's fixed income. That's bonds. And if you think bonds are boring, try buying a 50-year bond that moves 45% in 1 week. Yeah, it feels good. Not many stocks move 45% in 1 week. And bonds, and we trade futures, and we use options. So there's many different ways to make money in bond markets. Yeah, you can buy a bond and it'll go up in price, down in yield. That's good. But you can also do something called playing the curve. Play 2 years against 30 years. And you can be right that way. You can trade government bonds versus high yield bonds, government bonds versus emerging markets. And emerging market bonds move. Emerging market currencies move. So I have a blast. I have a great time in the fixed income universe, because if you understand what drives global economics, and if you're interested in international politics, then currencies and bond markets are for you. And that's what I love doing every morning, getting up at 6 a.m., doing my yoga stretching. I turn on CNBC. I turn the volume off so it's on mute. I just watch the numbers go across as I'm doing my stretches for about 20 minutes. And I know how my portfolio is already being impacted by what's going on the tickers, because I can form a picture within basically 20 seconds of what's going on in the global markets just by looking at a few currencies, commodities, and equities. And I know what I want to do that day, because I love to be able to have the opportunity to get on the world stage, new. Every day is new, it's different, and hunt for opportunities, about putting the pieces of the puzzle together and being right.
You talked about university education being a ticket. How do you see financial designations such as the CFA or some others that they have out there, FRM? How do you see that? Do you see that also as tickets? What do you see in difference?
Yes, the CFA or other things, like I have a CMT. It's the antithesis of a CFA. CMT is about, it's a 3-year program, chartered market technician. It's about understanding behavioral finance. It's about technical analysis. It's about, looking at patterns and repeating cycles and looking for opportunities. So CFA is a necessary ticket, essentially. I view an MBA as more important than having a CFA. But having a CFA now is almost a requirement. So if you're going to get into banking or portfolio management or be an analyst, get your CFA, get it done as soon as possible. It's important for marketing, because when you're a money manager, you're entrusted with somebody else's money. And if they see the CFA next to your name, they say, oh, he must be very smart. And I will tell you, having a CFA isn't going to help you make money for your clients. It makes people feel better, and that helps you get a job, and it helps you collect assets under management.
Okay. So also during the presentation that you gave back in May, you left us with 3 pieces of advice that you would tell young professionals. So would you mind sharing that with us here?
Absolutely. It's number 1 is save your money. I don't care if you save the money and put it in your mattress. It's probably better to buy U.S. equities right now, buy a mutual fund. Saving money, the sooner you start saving, the sooner you can retire. if that's your end objective. I don't ever want to retire. I will play golf and I'll trade my own money because that's what I love to do. Saving money enables you to have options in the future. This word option has come up a lot in this conversation. It gives you choice, because choice is a luxury. So save your money because life is expensive. When you get out of university, you're going to want to buy a car, you're eventually going to buy a house, and you're going to have kids, and kids cost a lot of money. And eventually, you're going to get fired from your job someday. You may get fired when you're 35. You may get fired when you're 45. And let me tell you, when you're in your 40s and have a family and you lose your job, or it's not a nice thing, because everybody's depending on you to bring home the money. You need money for a rainy day. Yeah, you need money for retirement. If you start, I did this exercise with the American Boy Scouts because I taught a class last weekend for a merit badge to be Eagle Scout last week in personal financial management. You start at age 20 and you want to save $1 million, earning 5% interest compounded. You have to save $650 a month starting at age 20 so that at the time you're age 60, you have $1 million. That's earning 5%. And I'll tell you, $1 million is not a lot of money nowadays. That's true. So save your money. Second thing is networking. Yeah. Someday you're going to have to reach out to somebody and say, I need a new job. Yeah. Networking, socializing is key to managing your career as you go forward. Because you will eventually say, I want to change jobs. And you get a job more easily by knowing people, somebody who opens the door for you. 3, visibility. Raise your visibility. Market yourself inside the firm you work at. Nobody is going to stand up and say, hey, Leo and Luke, you guys are great. Well done. Oh, you guys are awesome. Yeah. I'm going to give you a raise. No, you have to market yourself, not in an arrogant fashion. Find ways to differentiate yourself, make your voice heard, get your face known. You write a blog at a company, speak to people in management, have that 20-second elevator speech. Hi, my name's Leo. I work as an equity analyst in this sector. This is my favorite stock, and this is how I look to add value to my company. Boom, 20 seconds.
That's very good advice, definitely. We've been trying to use some of the advice that you gave me back then right now. So it's been working already. Do you have favorite finance-related books that you would like to share with the audience?
Sure. I guess there's a theme that has been probably recurring in the past hour of conversation. It's really looking for designing your own way, a system of analyzing markets so that you increase the probability of being right. It's called having an edge. And something that I'm fascinated about is repeating patterns or repeating cycles. The most important book that I read in 1998 and has been absolutely true and also helped me understand what was going to happen with Trump. It was a book called The Fourth Turning by author is Strauss. The Fourth Turning. He wrote a follow-up book called Generations, The History of America's Future. To put it quite simply, there are 4 generations in a big cycle. Each generation is 20 years. I mean, generation of people. Because a person essentially lives 80 years and goes through 4 stages of life. 0 to 20, 20 to 40, 40 to 60, 60 to 80. We are now in the 4th turning of America's economic and historical cycle. And this book covers the past basically 500 years of generations in America. And you know what? Each cycle repeats. without failure. You can actually predict the political future going forward, and therefore the economic future, by understanding these cycles that repeat. Let me give you just one example. So the numbers. 1929 stock market crash. Add 80 years basically to 1929, and what do you get? 2008, 2009. Next big one. 80-year cycles.
Okay.
And this is why in the fourth cycle that America is in, it's looking for new leadership, or looking for new answers. People are disenfranchised with the system. They don't like their political leaders. And if you read this book, you will understand what's happening now and what's probably going to happen for the next 10 to 20 years. So that's a big picture. There's 3 other books I'd recommend, and they all have to do with one thing: technical analysis, charting, in order to help you understand patterns, because you're going to look at price charts a lot, and patterns repeat. Just like these generational cycles repeat, price patterns repeat in all different markets. So the most important one for me is intermarket analysis by Mr. Murphy, John Murphy. It helps you understand the relationship between stocks, bonds, and commodities, and which of these asset classes performs best in different parts of the economic cycle. And then there's another book called The Elliott Wave Principle by Mr. Bob Prechter, Prechter. Elliott Wave, again, it's about patterns and cycles. And they repeat, whether it's on a minute basis or on yearly basis. Same patterns can be seen and repeat. And you can basically know how much a market is going to move, or how much a market will retrace, and what your buy and sell points can be, i.e., discipline. And the last one, I really enjoy Japanese candlesticks. And because I'm picture oriented, this book has all pictures in it. And so I memorized all the pictures. And when I see it on my Bloomberg screen, these patterns, I automatically identify the pattern. It's called Japanese Candlestick Charting by Mr. Nison, Nison. And there's a book I had next to my bed when I started in the industry from 1990 to 1992. And I looked at it every night. I just looked at the pictures. And so when I look at the charts every morning, every day, I see opportunities.
I think, I don't know exactly who said that, but someone said that experience is pattern recognition.
There you go.
And I'm sure that you can recognize patterns in probably less than a second when you look at it.
Exactly. Yeah. Okay. My colleague also sits next to me. Again, we don't talk to clients about technical analysis, but he says, okay, I'm going to show you a chart. So he shows me his Bloomberg screen. I'm not going to show you what this is, but what do you think of the pattern? Okay. I said, okay, it's going down. I said, okay. Yeah. Exactly, experience. You will see a chart or a pattern and say, I know what to do. I've seen this before. And if I'm wrong, I know where to set my stop loss.
Okay. Very good, Brian. Well, just before you go, one last question that we had is, Luke and I have learned a lot from what you just said. I think it won't be just valuable to the people that we're trying to reach with this podcast, but also to the two of us, as we're not. I'm not as young as Luke, but I still consider myself starting out in the world of finance. If there is one thing that you would leave our audience with today, what would that be?
I'll give you 3 things. 1,
we can take 3.
Develop and design your own system that you're comfortable with in making money. Don't listen to anybody else. Okay? 2, find a mentor. 3, find somebody you love and spend time with them and enjoy life and cherish each other. Find your soulmate.
Very nice. I think we'll leave it at that. Well, thank you very much again, and thank you for accepting to be interviewed by us, and we hope to stay in touch.
My pleasure.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
The information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. Any copying, distribution, or reproduction of this podcast without the permission of the creators of the podcast is strictly prohibited.